On Canberra Live with Leon Delaney. Money Matters with Luke Smith from Envision Financial Services.
At around about 22 minutes to 5, Luke Smith, good afternoon.
Good afternoon, how are we?
Oh, look, we're really, really well. It's a Friday afternoon.
It is.
I like Fridays. I
Me
look
too.
forward to the weekends. Everything's good in the world, and we're going to
is.
talk about tax time once again. But before we do that, you've got a serious point to raise about a situation where you're trying to do your best to help a client.
Correct.
But you're running into bureaucratic difficulties.
Yes, very much so. So unfortunately, a 20-year client of mine passed in the last couple of weeks in Canberra Hospital, and after fighting for 8 weeks to come out of the coma-like state that he was in, they were unfortunately had to make that horrible decision to turn him off, to end his life, which is absolutely tragic. And I'm just appealing to anybody that works at Canberra Hospital that can contact my office and assist a grieving widow with the paperwork that's required to keep things moving in her life, because she had to go down there and make that horrible decision and has been giving nothing paperwork-wise after asking and providing numerous documents that were required for financial reasons. She's had nothing back, and I'm reaching out to any of our listeners that if you work at Canberra Hospital, your partner's at Canberra Hospital, you're in management at Canberra Hospital, you're the janitor at Canberra Hospital, I don't care what you do at Canberra Hospital, if anyone can contact my office on 6260-4749, leave your name and number, and I will get back to you. And just appeal to anyone we can get in touch with to help this poor woman try and get on with what's left of the remainder of her life after a horrible experience.
So basically what you need is to get the appropriate documentation that can then be forwarded to the life insurance people and all of that sort of thing.
Correct.
Yeah.
And she doesn't want to go back in there after what she's just had to go through, unfortunately. And it's not that anything's happened at Canberra Hospital. It's just that she does not want to walk back in the building after what she's had to go through.
Yeah.
And we've tried a few different avenues to get what we need, and this is literally our last chance to try and appeal to somebody in the community to help us. If you can contact my office, leave your name and number, and assist her in getting what she needs, I would be eternally grateful.
Okay, so if you can help out, get in touch with the office at Envision Financial, and hopefully we can provide a little bit of peace of mind after what's been an extremely difficult period of time.
Yeah.
Now, as we approach the end of the month, let me quickly check the calendar. It's Friday the 13th, which means there's only 17 days to go until the end of the financial year.
Yep.
And as you have pointed out repeatedly, this year, the 30th of June, falls, was it on the Monday?
Yep.
So that means if you need to do stuff before the end of the financial year, you might need to do it like a week beforehand or more, just to make sure that everything clears in order to make sure your affairs are in the condition that you want them to be in.
Yep.
Now, today's topic, though, is about maximising your tax deductions, because obviously, if you want to spend money on something and then claim it as a tax deduction, you need to do it before the 30th of June.
Correct.
Because if you do it after the 30th of June, you cannot apply for that deduction in this financial year. It has to be next financial year.
Exactly right. And again, it's really get to your trusted advisor, whether it's your financial planner, your accountant, your bookkeeper, whoever's helping you. Get as much information as you can now so that you can avoid, I wish someone had told me. I wish someone had explained that. If I'd known I could have done that, I would have done it. And that's really what we're going to touch on today, because we've banged on recently about deductions to super, which, that goes without saying. We've talked about pensions to fund those deductions and using transition to retirement legislation. But we also then want to think about, let's get our prepaying hat on. So what deductible interest costs could we prepay now for the next 12 months? So you might do that with a margin loan where you prepay the interest and claim the next 12 months of interest in this financial year. That's a great idea. You could prepay potentially the interest on a home loan. That'd be great because you're bringing forward that deduction to the end of this month where you can claim it in this tax return, not the next one. Another great one to think about is if you have income protection. So if you have income protection securing your salary, the premium associated with income protection is tax deductible. So if you were to contact the insurance company that provides the policy and you are the owner of that policy, you could prepay the premium for the next 12 months and claim that next month in July, again, with the aim of lowering your taxable income. For the self-employed people out there, remember that we have the $20,000 instant asset write-off. So that's where you can go and buy something up to the value of $20,000 and claim 100% of that as a deduction in this financial year as well. So it's really just about keeping people thinking, not just about the super side of things, but other ways that they could make the most of their cash flow and claim those deductions so that you can manage the outgoings when you lodge your tax return this
There's
year.
a couple of simple examples too, isn't there? For example, if you're running a business and you have a bill that's due in July,
Totally.
you can pay it in June and claim it this year.
Beautiful.
Rather than waiting till it's due and then having to wait another 11 months to actually claim it.
And this is where good accountants are proactive and they're on the front foot and they're coming to you with these sorts of strategies, especially for the self-employed people, because there's a myriad of things that go on, and that's where getting advice is of value. This is where people need to be proactive, not reactive. And if you've got that type of accountant and they're not raising things with you, get on the phone, chase them down, ask them for the information. You shouldn't have to, but again, they're probably busy getting ready for 30 June. You're busy trying to get ready for 30 June, and two busy people generally don't get a lot of communication together. So if you're not sure, ask. 95% of advice providers would be able to find the time to bring you up to speed with whether you can or can't do something. I would much rather pester my accountant and say, hey, can I do this and this and this and this? And they go, no, no, yes, yes, no, than find out later that I've left good money on the table that could have helped me from a tax perspective in the next 3 to 4 weeks.
Here's another one. If you've got a business vehicle lease, pay the lease in advance.
Yeah, possibly.
Possibly? Oh, no.
I'm not an accountant, so I'm going to leave that one alone.
All right.
Just so I don't upset the accountants out there. But again,
in that
ask
case,
your accountant if you
ask
can.
your accountant if that's an appropriate idea. All right.
In all other situations, ask your accountant.
Yeah.
But again, just think about what you have coming up. I think also from a billing perspective, if you've had a massive year, hold those bills off till July. Mm-hmm. Drop them in July. Don't add to an already great year that's going to cost you more from a tax perspective. But if we can try and manage accounts and then also manage deductions and expenses and how you work your cash flow, I think you want to try and get yourself in the best position possible, because as any self-employed person knows, you work really, really hard and you take all of the risk and you carry all of the burden and you do everything you can. You need to be able to catch a few of these breaks and make the most of the opportunities that are available. And, the income protection, the prepayment of interest, the prepayment of certain things is one that can sort of slip through to the keeper if you're not aware that you can do it. But again, speak to your banker, see what you can do about trying to lower your taxable income. So that you've got as much of that money as possible working for the right areas. And that includes maximising your deductions to $30,000, using a transition to retirement pension to fund that deduction. Pull money out of a spouse's name and put it back into your super if you need to. Take money out of an offset account. If you don't have money in the bank, look at your offset account. If you can take $10,000 out of an offset account at 6%, put it into superannuation and save 25%, I'd say that's good maths. And then you can get a refund and put the money back in your offset account. So again, think outside the box in relation to where you could draw money from. Not just, okay, I have X in the bank. You may have access to redraw facilities, to offset accounts, to business loans, to lines of credit. Use those things to your advantage. But you need to be thinking about it. And I say we've been banging on about this for a couple of weeks to give people as much time as possible.
Well, that's right. A lot of the things that we've already covered in recent weeks are related specifically to your to your superannuation and the tax deductible contributions that you can make to the super. It's probably worth just recapping a couple of those. If you've got a little bit of extra money that you've got lying around not doing anything in particular, as long as it's within the limits that apply, you can whack it in your super and get a tax deduction for it.
Exactly right. So we know that $30,000 is the limit that you can put into super and claim a deduction. And to recap, that includes what comes from work and what comes from you. And that's from all employers.
Yeah.
It's not 30,000 per job, it's 30,000 for the whole shooting match.
Yeah.
You also can look back and say, well, is there any room in the last 5 years that I could use where my super is less than $500,000 at 30 June 2024? You could put in a large contribution and get a very big deduction where you may have had $10,000 of space in the last 5 years. You could put $50,000 into super and claim 100% of that as a tax deduction. Now, what have you got to be able to do that? You need a super balance of under 500,000 at 30 June 2024, and you can look back as far as 2020 at the moment. So 2 ways to get that information. Call your fund and say, can I get my concessional contributions for the following years, please? They will give it to you over the phone. Or the alternative, which I don't trust all the time, you can log into MyGov. And if your super's linked in MyGov, you'll have your cap space on there as well. Now, I say I don't trust it. The reporting from some super funds can be delayed. So I would get that as your starting point if you have it, and then go to your fund and confirm the numbers. And then look at trying to make the most of that legislation, because it's a very, very powerful way to get 19, 20, 25% deduction, which you'll then be able to lodge in your tax return at the start of July for a very, very good tax outcome. So think about that leading into the end of the month.
Luke Smith from Envision Financial is with me in the studio today, and we're talking about maximising our tax deductions before the end of the financial year. It's about 11 minutes to 5 now. Back with more in just a moment. Luke Smith from Envision Financial is with me in the studio today, giving me some good advice on how to maximise my tax deductions as the end of the financial year is looming. What are the key things to remember?
So get some advice, get on the phone, call your trusted advisor. They will be able to make sure you understand what you can and can't do, especially from an accounting perspective. This is where your accountant really adds value to your situation, more so than just tallying up the numbers in July. Check and see if you do have any cap space with your fund. We said before the ad break, give them a call, check MyGov and see if there's any room. And if you can, get money into it. Some different ways to fund those contributions. You could use an offset account of an investment property. You could use an offset account of home. You could use a line of credit. You could go anywhere where you can get hold of the money to put it into superannuation. And remember that if you are putting money in, you need to lodge a notice of intent, which we've discussed in previous shows, to tell the fund that you want them to remit the tax on your contribution. If you're very close to the $2 million limit in relation to super, whilst this isn't a deduction, again, keep in mind that if you have less than $2 million in super at 30 June, you could make a $120,000 contribution, which is not deductible, but again, it's one that we're thinking about 30 June. So keep that in mind. If you're looking to try and lower the tax component of your superannuation to manage the tax for your estate, get $120,000 out and back in before June, provided you're eligible to put the money back in. Then you might do $360,000 on the 1st of July. That's a great way to implement a recontribution strategy to lessen the tax from an estate perspective. Next one would be to prepay interest where you can. Is it a margin loan? Is it an investment loan? Is it a loan on a rental property? Is it your income protection premium? Prepay anything that is deductible so that you can bring forward that entire annual expense in your tax return in June. For the self-employed people out there, make the most of that $20,000 instant asset write-off. It's not the $1 million number that it was through COVID. We all wish it was, but it isn't. But again, a $20,000 deduction for something that meets the criteria for its use, a wonderful way of bringing forward some income benefit in this financial year. And then the last one would be, don't leave it too late. Okay, we've been banging on about this for this entire month, and I can bet your life someone will come in on the 25th of June and ask me how to make a super contribution. And check with your fund as well. We're finding that different funds have different soft closing dates in relation to where they will guarantee that it will be processed. So check with your fund. Don't assume that the doors are open until the 28th or the 27th or the 26th. Check with your particular fund, because we're finding that different funds have different soft closing dates where they'll guarantee that something's been processed. So again, don't assume, because that generally leads to tears.
Well, that's what they say, isn't it? If you assume, you make an ass out of you and me.
Correct.
You've seen that, haven't you?
I have.
There you go.
I have.
So we've reached the point in the program now, Luke, where I have to ask, where can listeners get more information?
Yeah, so 6260 4749. If anyone can help me with my original plea at the start of the show, 6260 4749 is my office number. Envisionfinancial.com.au on the internet. That's Envision with an E. We've got the strategy stacker, Luke Talks Money, on iTunes and Spotify in relation to the podcast. We've got Envision Financial Canberra on YouTube, where we have a back catalogue of all of our shows. You can watch them on your iPhone. You don't have to read anything. It's lovely. And all of these types of deductible strategies are in Smart Money Strategy, your ultimate guide to financial planning, in all good, bad and online bookstores.
Fantastic. Luke, have a wonderful week, and we'll catch up with you again at the same time next Friday.
See you next week.
Luke Smith from Envision Financial back in the studio again next Friday afternoon at the same time right here on 2CC.